everybody, and welcome to the last episode of the ESG and Tech Show right here at VectorVest, live online at YouTube. My name is Susan HayesCulleton and I am the presenter of this show and have been right throughout the year, and I have to say it has been such a pleasure to bring the content to you that we do right here, as I say, at the ESG and Tech Show. Now, it is a kind of, it's dark and it's cold and it's wintry right here in Ireland where I'm streaming this live from. And of course, I can imagine that wherever you are, I hope that you're warm and snuggly and staying inside and settled in for what I'm going to talk you through tonight, which is, of course, the 5 trends that have characterised 2021 and that give us clues for what is about to come in 2022. So, first and foremost, as I always do, can you please tell me there in the chat where you're joining us from? I'd love to hear what parts of the world that you are coming from and where you're tuning in from this evening. And as always, I have your comments right up here in front of me. I'm looking here at my device, so I will be able to see them as they come in. So hello there, Chris. You're very welcome, and please do tell us where you're joining in from. And like I said, to each and every person, we'd love to hear where you're coming from, where you're joining from. I see Paul is joining from Stoke-on-Trent in the UK, Chris here from Minnesota. We also have somebody here from Ontario, Canada. Harry's here from Belgium. Miguel is here from Puerto Rico. Okay, I can see that there is quite the extensive view right around the world. Please do keep your comments coming in. I can also see Robert is joining us here from South Carolina. DJ is from Gresham in Oregon. Larry is tuning in from the US. Erol is here from New York. Ian is here from the UK. Curtis from Texas. Robert's from Ohio. Lee is from California. We also have somebody joining us here from Massachusetts. Martin is here from Port St. Lucia in Florida. Tigan is here from Oaxaca in Mexico. Badger, I see you're here from cold and windy Wisconsin. Miss is from California. We've got Boston, Orlando, Halifax, Connecticut, Toronto, Florida, San Jose, Dallas. Right, I can see that you really are joining us from all over. So as I say, please do keep those locations coming. What I'm going to do with you today is I'm going to take you through the top 5 trends that I have seen right throughout 2021. Now, I will take you through what's been going on over the previous months. And sometimes what I'll do is that I will actually even go back further. I go back to years before that to talk about how these trends have changed over time, so that we can really see, as I say, what 2021 has brought, but particularly as well where we're going in 2022. Now, I can also see David is joining us here from Canada as well, and it's really, really great to see so many people joining. So what I will say is just pop on over to the chat. If you're on the mobile version, you will need to close the comments and go over to the chat. If you're on the laptop version, you can simply head on over there to live chat and I will see you. We have Jim who's joining us from Timbuktu. I think that's the first time I've had somebody from there, which is great. Okay, I also want to tell you that last Thursday I was host for a show in London called Sustain Social. And I also wanted to bring you the insights that came from that. What did the key speakers say? What were they talking about? And what insights did they have to share from that particular show? And that's also what I want to share with you. So tonight really is going to be an action-packed show. VectorVest there saying, VV Nation, welcome. Yes, indeed. You are super welcome. And what I really want to do tonight is to make sure that I'm hearing from you and that I'm hearing what you feel the key trends have been as well as we go along. Now, one other point before we get right stuck into this is that I would also ask you, if you're enjoying tonight's content, we would love if you would like the video, please. We would love if you would just give us a like, so that then when other people are thinking about where they're going to get their content that will reel in the ear for them in 2021, that we will then be able to showcase this particular video and we can give them what it is that they're looking for. So we'd love if you would like the video and of course subscribe to the channel if you haven't done so already, so that you can get every single show for 2022. You will get a notification to say when we are going live. Hello from Burkus, who is joining from Orlando, Florida. Brilliant, delighted to hear that. All right, let's start off with number 1. Number 1 is climate fintech. Okay, that's the number 1 trend that I'm seeing. Sorry, when I say number 1, that is the first of the 5 trends that I'm going to take you through. For example, climate fintech is when we would use financial technology, which is what fintech is, fintech in order to enable the companies that we're working with to improve their interaction with technology and with the environment. Okay. Now, I just want to go back just a little bit further, right? Let's go back. And if I was to characterize one of the key ESG trends that we saw in 2020, I would say it was shopping local. Shopping local became the really big thing to do in 2020. Lots of small businesses were struggling with the newly imposed restrictions. And as a result, a lot of people wanted to get behind small businesses and shop local. Our relationship with space changed as a result of lockdown. And of course, there was a massive proliferation of e-commerce. So for all those reasons, one of the things that really characterized 2020 for me from an ESG point of view was the S of let's get out there and support our local businesses. What I think we're really seeing in 2021 is something slightly different, and that is how do we use our everyday spending? How do we use our everyday personal finance in order to help the environment? With all we've seen with COP26, we all know about the 2-degree implication right now in Ireland. There's schools closing and there's a red warning out there for a storm that's coming tomorrow. Like, look, none of us need to be told about climate change and the impact that it's having, and of course that it's all down to individual actions. So I want to talk you through, for example, one company that actually launched its SPAC in 2021, specifically in August. And I want to show you this as a bellwether, as an example of a company that is soaking up this climate fintech opportunity, how we can use our everyday spending in order to be able to make a difference to the environment. So what I'm going to do is I'm going to pop on over here and I am going to go to this company here, which is called, I'm going to go over here to, first of all, this article here from Fortune. And this is all about new generation of climate fintech startups. This was written in September, but particularly what was spoken about here is Aspiration. Aspiration, the sustainability focused financial services company co-founded in 2013, faces increasing competition in consumer solutions to climate change. And what it goes on here to say is that it offers pay what you want savings accounts and investment vehicles with a pledge not to invest in fossil fuels. And in addition, and this is the key thing I want to point out to you, is that in August of 2021, Aspiration announced plans to go public through a SPAC, a special purpose acquisition vehicle. Now, acquisition company, I mean to say, we did a sole episode on SPACs this year. Solely, I looked at SPACs because that was one of the really big rising trends as well in the financial services world that I wanted to talk to you about. And as you can see here, it valued it at 2.3 billion in August. And this was the first ever sustainability focused consumer financial services provider in the public markets. Now, if you want to go on then, and as I have done for you, and if you want to look at the latest Aspiration press release, let's look, this was only released last week, okay? Let's just take a look at how its revenue is changing, okay? And let me just get, it is press release, its latest press release is up here, the third Q3 2021. Look at this, just look up here, all I'm going to show you is the headlines because it gets across the point. Total revenue increased 645% year over year, generating profits that was a 1,178% year over year increase. And year to date, in September 2021, revenue of 62.1 million compared to 9.3 million, a 570% year over year increase. So this is the type of growth that this company is going through. So you might say, okay, this is interesting. What exactly does this do and how is it different? So let's take a look over here now at its website, right? So Aspiration Partners, okay. Aspiration Partners. And here we go, green financial services. You can change climate change. And what happens here is that reforest while you shop, and the whole essence of this company is that every time you swipe your card, they plant a tree. They've got a free ATM network, so obviously it's making sure that there's genuine value as well in the offering that's been given. Changing about how quickly you can clear your payments, neutralize your car's carbon, and save up to $300 per year in fines. So there is a financial element to this, there's a technology element to this, and there's a climate element to this as well. So if I scroll on down, one card, zero footprint, and if I go way down here, right down, yes, this is the other thing. is that, which came up here, is that there's a point here that makes the 4 biggest banks in America lend more than 210 billion of their customers' money to fossil fuel projects every year. That's a lot of money. Every $1,000 you transfer to aspiration from big banks has the annual planet saving climate impact of up to 6,000 miles driven by the average car. So what it does is it really points out how you can make the impact. And what I thought was interesting here, I ran this test. Let me just zone out here, and okay. So let's say, how many times per week do you use your debit or credit card? Let's say in my case, I'm going to put up there 25, and it says every time you swipe your card, they're going to plant a tree, which means that 1,300 trees would be planted as a result of how often I swipe my card. And this is the point that matters here, is that this is, I believe, one of the trends that is going to characterize 2021, is that how do we use our money in order to help climate change. We've already seen massive change in this, and I'll talk about this more in terms of the amount of money that's being used in ESG investing, but that's using your investment dollars or your investment euros, your investment pounds. We've also seen a variety of other things that have happened along the way in order to help people, maybe for example to reduce, reuse, recycle. But when we think about how do you incorporate activities that I undertake every day, like for today, I swiped my card. Well, I used my wallet, but I swiped my card today twice so far. I intend to do so another time. So is there a way in which that I could use that actual spending? Yes, of course, that I could be buying sustainable products with my money, and I could be choosing, instead of, for example, buying a cup of coffee from just a cup of coffee place, is that I make sure that it's organic and that it's fair trade. But I could also then be using my day-to-day activity by simply using a card like this, where then as a result of me swiping my card, they plant a tree. And that's the point I'm trying to make to you, is that I think in 2022 we're going to see more and more of this, because there is such a big opportunity for this. In fact, and I'm going to be making sure that I share lots of insights with you from that conference last week. I do want to share one particular one that I heard, because I think this point is very important. I want to quote a statistic to you. This is the size of the opportunity, right? The actual size of the opportunity that takes place, that is currently in place when you come to thinking about how much is involved in moving to carbon neutrality. And the answer here is that one of the speakers last week quoted, his name is Randeep Saman, and he came from M&D Investments from the UK, and he quoted these numbers. He said, Bloomberg New Energy Foundation highlights between $92 and $173 trillion is required in spending to reach net zero. The UK alone needs £1.5 trillion in order to become carbon neutral. Like, oh my God, that is a lot of money. That is a lot of money. And of course, that money has to go somewhere in order to achieve that objective. The companies that are willing to do it, companies that are actually going to really make a significant difference, they're going to have government funding. They're going to have companies buying them. They're going to have individual subscriptions. It's going to be huge. Now, he goes on then, Randeep went on then to quote from Bill Gates. He said that in order to achieve this, we need 10 new Teslas, 1 new Amazon, a Google and a Microsoft is likely to be created over the coming decades in the climate technology investing space. And that is the market cap today of Tesla, Amazon, Microsoft and Google today is approximately $6.5 trillion. So we are really and truly looking at very, very, very significant numbers. And that is my first trend that I wanted to talk to you about today, is the rise of climate investing, climate fintech. First of all, let's get your reaction to that. So tell me, do you take note these days of your purchases one by one? Are you trying to use your money on an everyday basis, not just from an investing point of view, but are you thinking about where you can spend your money, how you can spend your money that is more sustainable? Do you think about shopping local? Would you consider using a personal financial services provider that enables you, as a result of your usage, not to offset it, but to use your usage in order to develop something that is helpful to the environment? Let me hear your thoughts on this, right? So just interested there. Let's just hear what you have got to say on this. So I'm just gonna give you a moment here, and let's just hear what you have to say about, are you somebody that wants to use your investments for a specific, your everyday personal finance for a specific purpose. As you're commenting there, I'm just going to give you some examples of other things that are going on from a sustainability point of view. For example, are you somebody that wants to work for a company that has a CSR policy? Are you somebody that wants to put X% of your money into maybe a certain charity that really makes a difference? Are you somebody that wants to make sure maybe that your days, that a company that you work for, that certain days are given in lieu for a charitable cause? Are you somebody that is pushing the sustainability agenda within your organization? Are you somebody that is using the consumption, are you somebody that really makes a conscious effort to use recyclable materials? Are you somebody, I'll give you a statistic on sustainable fashion, for example, is that the fashion industry is responsible for 8 to 10% of the carbon footprint globally of the world, and that is greater than shipping and aviation combined. So are you somebody that is thinking about the circular economy when it comes to your purchases? Is that how are things going to actually be used, or how are they going to be actually, how are the materials going to go back into the earth? So Robert says here, if possible, yes. Martin says no, need and price are most important. So Martin says need and price are most important. So as a result, what do you need and how much does it cost is your primary goal. Okay. And of course, like, I'm here simply to hear your thoughts on this. I think myself that we are going to be, I think it won't be so much up to the individual. I think the individual will, Martin, to take your point, right? I don't think that it's going to be up to the individual more and more to be able to figure out these choices. I think it's going to be up to businesses more and more to put forward the idea that actually they need to make it easier for individuals to be more sustainable. That's what I see. And that's what I see a company like Aspiration doing very well. Is, Martin, like, if I go and I get my cup of coffee, it doesn't matter where I go. If I swipe that card, a tree is planted. It actually dovetails in with what I'm doing at the moment. Okay, I'm going to keep an eye there on the chat. I'm going to see what else people are going to say on this point as we go along. Okay, now, let's now talk about the second area that I would like to share with you this evening. And the second really big trend that I see is all to do with robo-advisor. Again, I had another episode on robo-advisor. The increase in the uptake of robo-advisor is really, really, really significant. And I shared, like I say, a whole episode on that. But what I want to do now is I'm going to show you some developments that we have seen in 2021 that I think are going to build and grow next year. So let me just pop on over here to my other screen. So look at this, Earthfolio. Earthfolio is a robo-trader totally focused on ESG portfolios. Totally focused on that. So it's not just a robo investor, a robo trader like I showed you. Like, one of the biggest ones and the most technologically developed ones is Betterment. Okay, and Betterment in here is one that, as you can see here, is built to make investing easy. But Betterment now also have an opportunity whereby you can simply put money into an ESG portfolio all the time. I'm also going to pull up another one here for you, and that is one that, of course, you can understand that I would be in favour of. And another, well, this was a fantastic Female Fridays episode we had, was just around the absolute business case there is in investing in gender diversity. This is one from example from Elvest, and this is, here's where you can invest totally based on buying shares in companies that are founded or co-founded by women and other underrepresented communities. The reason that I'm bringing this up as my number 2 trend is because these robo traders are set and forget. Is that all I have to do is once I have to make a decision that I'm going to invest, for example, here with the Earthfolio, just once. If I'm going to log in here and I'm going to fill out the questionnaire, and in here then I'm going to say that I want to invest in ESG portfolios that are managed. That's what I want to do, and that's it then. All of the continuous investing decisions that I make are going to be made with an ESG focus in mind, specifically the E in ESG. That's what's going to happen there. Simple. And this is the thing, is that if we see a trend that is increasing in robo-investor, if we see more and more robo-investors are either giving an ESG opportunity are setting up solely with the point of view of an ESG focus, well then, of course, you're going to see two trends colliding there, which is the rise and rise of ESG and the rise and rise of robo-investor together. Now, I did ask the question in my last episode as well as how many people would like to invest in a robo-advisor type of idea. And I got a maybe in the future, I'm not sure really. And then of course the big bazooka that needs to be considered when it comes to a robo-advisor at all is, what about if you want to talk to somebody? What do you do then? And this is how I also find, like, this is another trend that's happening in robo-advisor, is they're more so becoming hybrid rather than just a pure robot investing on your behalf. For example, over here in Betterment, I can have my socially responsible investing element here, okay, and I can also see how it's going to make an impact. And it's another trend I'm going to come back to again later on, future, that I can feel good about. Still have questions, but particularly this is that you have a company like Betterment that is using individuals to help and build the algorithms. And the other thing is, based on what we're seeing up here when it comes to its pricing, you can see that the upper tier includes unlimited calls and emails with the team of CFP professionals. So when we're looking at two worlds colliding here, rise and rise of robo-advisor, and I see that my camera there has just got a little bit blurry, so I'm going to fix that. And it might just need to be, okay, I'll fix it there in a moment. But my point here is that you have got the unlimited calls and emails with the team. You've got the robo-advisor itself doing its thing. And on top of that, then you have the social investing that are all coalescing all in together. That is where I see the second trend coming from. So now okay, Robert says you'd need to see the track record first. And yes, you can. When it comes to all these robo-advisors, you absolutely can. Of course you can. The point is that it's actually there. It's there to go, and you can see the way in which that this is happening in the background. So let me hear from you now. Do you think that there is some capability of robo-advisor and ESG to come together? Do you think, I'm basically asking, do you agree with me so far in my first two trends, is that I can see climate fintech rising, and I can see robo-advisor rising in conjunction with ESG investing. Let's hear what you have to say. Do you see both of those trends moving together at the same time? Or before I move on to trend number 3, of which I'm very happy to do, and I'm gonna take you in a very different direction, is I would just like to hear from you right now, is can you tell me what you think the top trends in ESG have been so far with technology in 2021? Okay, so Tushar says yes, he agrees with me so far, okay? Because I'm going to surprise you with the next one. The next one you may not agree with me on. Mike says yes, Martin says yes, okay, yeah. Let's just hear, and is there any others that you would like to add in here? Tushar, Mike, Martin, is there any other trends that you see? Let's see if we're both agreeing at the same time. But there's one, the direction I'm going to take next, I think will surprise you. It surprised me. When I really went and researched it, it surprised me. Just going to give you a moment now. Let's just see what else you have got to say on this note. So far, we're in agreement. Bar says governments need to encourage businesses to produce more sustainable products by banning most disposable items. Now, that's interesting. So single-use plastics, there's been a lot of change in that this year. Let me see. Toshar says cars and trucks going carbon free. In the UK, for example, we are seeing the capability now, whereby we are in the UK. I think all diesel and petrol cars are going to be banned by 2030. Let me just pop on over here and see. Just going to check that now for you. I think that might be the case. And just going to check that, where we can see here that diesel and petrol cars banned UK 2040. Is that to be the case? and I believe it is. Yes, indeed, I believe that it is. So that, and it just shows you, it really and truly does show you that that is, the government announced in November it would move forward a ban on the sale of pure internal combustion engine cars from 2040 to 2030, but said it would allow the sale of hybrid vehicles until 2035 in a significant industry. Let's see, what else, what other ideas do you have out there? What do you think is going to happen by that stage? I'm just going to give you another moment here to think through that, because as I say, what I'm seeing is that there is certainly an awful lot of capability for this to happen by that period of time. Okay, looks like we're getting a little bit quieter on that, and all right, that is a-okay. Now, the next one that I'm going to take you through is actually all about, and it's focusing very, very much on what happens when we look at who is investing. And I think that there is a lot there that we need to discuss. Now, here was where I was surprised, okay? Here was where I was very surprised. I thought to myself that the key demographic that is driving ESG is Gen Z. Often we hear that Gen Z are the people, we see, sorry, just before we go on, Tushar says solar and energy will get in focus. Okay, and let's talk about all of those. Let's see who's driving it. But I really did think it was going to be Gen Z. All right, we often hear Gen Z are the people who are out protesting. We hear that Gen Z are the people who are most vocal, and they're also very much gaining a more empowered voice when it comes to looking for specific benefits in our driving workplaces in the future of the world of work to make sure that they are offering sustainability within their job offers and within what they do. However, I might shock you with this, but actually it's millennials are doing two things that I think are worth talking about. Number one is this, okay? Number one is this, is that, because I have my statistics over here and I want to quote them correctly. A third of all millennials are taking ESG into consideration, right? 1/3 of all millennials right now are taking ESG into consideration. And I think that that was, particularly interesting. But if I was to go further than that, that is actually 1/3 is 33%, 19% of people who are Gen Z, 16% of people who are Gen X, and 2% of baby boomers are taking ESG into consideration. So what that tells us is that the group of people who are in between round about 25 to 39, that generally is where we see millennials being, they are the people who are taking ESG into consideration more and more. That's not all though, because then we also hear an awful lot about millennials that they're an awful lot worse off than their parents were at their age. They have got higher student debt, they have got higher student loans, which, sorry, it's the same thing. They have lower home ownership. So therefore, should we really be watching this age group? Well, interestingly, let's just think through what the impact of that is. Why do they have higher student loans? Why? Tell me your thoughts in the chat. The answer is because they stayed in school longer. Somebody like me, take my age group. I am somebody that went back to university when I was 30, and I then went on and I did a master's. How many more people my age have done that? I'm a CFA charter holder. That was also something that I did after university. And I also have a diploma in taxation. I also did that well after university. So in all of those cases, I had to invest in my education long after university. So what does that tell you though? Well, that tells you if they stayed in school longer, of course, then they have greater employment opportunities and salary expectations later on. Now, hold that thought. Second thing, they have lower home ownership. Why? Well, if you think about it, an awful lot of the higher career opportunities typically tend to be, before 2019 anyway, in urban areas. In urban areas, there was, of course, the higher cost of living, but they still stayed there. And yes, they are renting for longer, but that is because those they prioritised the career trajectory and opportunities they would have there over home ownership. Now, we'll probably see all of that change with the Great Resignation, with the disparate nature of the workforce today, and with the fact that you can now work from anywhere, and legislation and regulation are keeping up with that. Number 3 though, here is another statistic on them, is that 86% of millennials today have financial plans in place for their retirement, which is significantly higher than the 73% of boomers who did the same at their age. You see, the thing is that the defined benefit pension is pretty much gone. You don't see it in the UK, you don't see it in the US, you don't see it in Ireland, you don't see it in Germany. You might see it still maybe in Japan, but the reality is that the defined benefit, the reliance on a company or a government to take care of your pension, we can't really rely on that anymore. So you see the rise of the defined contribution pension. You also see, of course, governments providing a lot of incentives for individuals to put money away for their pension in the future. You also see the rise of the capability of individuals to manage their own pensions through low-cost funds like ETFs and, of course, now robo-advisor. So let's put all of that together. What the millennial has done is that they have taken more time to be in education. They're waiting longer for home ownership, but are prioritising the place where they can actually grow their capability for their career aspirations. They're putting more plans in place for their retirement. The reality is actually the millennial is planning further into the long term, and it's taking them longer to get to the place where their parents used to be, because they can't rely on stable, reliable jobs. They can't rely on governments to take care of their pensions or companies to take care of their pensions like they used to. So actually what you're seeing is growing wealth of millennials, and that is coupled by growing focus on ESG. This is actually a very powerful combination. Very, very powerful combination indeed. So I was genuinely surprised when I went looking for those statistics. I really was. I was surprised at that, because I thought this really is quite interesting, is to see how can this actually change. So what I'd like to hear is your thoughts on this. Is when it comes to the demographics of who's investing, do you see what I see? Do you agree with my hypothesis? Which is that as we see people taking their time to actually make bigger life choices like buying a house, when you actually see that they do have student loans for longer, they are renting for longer, they are putting money in and more of it into retirement for longer, can you see what I see? Which is that this is pointing towards a fundamentally stronger financial future that they're going to have. Bear in mind as well that a lot of these millennials would have been either in their first or either in their first jobs or very early stages of their careers when the Great Recession happened in 2008, 2009. They have seen the impact of high debt. They have seen the impact of when you put too few eggs in too few baskets. They've seen the impact of this. So actually, I think that this is a very, very powerful groundswelling trend that I think could have make a really big difference in time. So far, I'm not hearing your reaction to that. So I will keep an eye on the chat over there, because I do certainly want to see what your thoughts are on things like that. Now, number 4, my number 4 trend is all to do with data. And speaking of data, I just want to share with you a couple of insights that came through from the event that I hosted last week. It was called Sustain Social. So let me just pop on over here and let me just show you a couple of slides here that came out of this, right? And first of all, that based on the data that was coming through from Interactive Investor, was that the E in ESG is the most important factor when it comes to investment decisions. It is the environmental side of things. Now, lots of people were saying that next year is going to be it's going to be the year of the S in ESG. The S is focused on social investing. The S is focused on gender parity. The S is focused on sustainability of underrepresented communities. The S is focused on enabling more people to have the opportunities and for it to be more disparate. And that is what was coming through in this one. Whereas so far in 2021, my number 4 trend is the rise of the amount of data that is available to us in order to make investing decisions today. And like I say here, there you can see that people are hungry for it. But what I was also interested in, this came up as well, is that in terms of shareholder power, 15.6% of UK shares are held by UK resident retail shareholders. Now, this is considerably up from 2017, and another big trend, of course, in 2021 was the continuation of transfer payments. Now, transfer payments are payments from the government to an individual without providing a factor of income, a factor of production. There's 4 factors of production: land, labour, capital, and enterprise. So, if, let's say, I'm going to sell something to you, I'm going to sell you land. For example, I can sell you a field, or I can let you rent out my property. I can sell you my labour, so I can work for you, or I can do a consultancy project for you. I can sell you my capital, which means that I can sell you something like I can sell you shares that are worth a piece of, or that are worth money, or I can lend you money and you can pay me an interest rate. Or, of course, I can also sell you my enterprise, which is that I can do things for you, that I can provide you with a good of a service that is better than the combination of what I developed in the first place. A transfer payment is when you give me money for doing none of the above. So a transfer payment, for example, would be a social welfare payment, when I don't have to necessarily provide a factor of production for that. That's what that is. So as we've seen the rise of that, okay, sorry, not the rise of it, as we've seen the sustenance of that. For example, in the UK this year, a furlough continued until April. We're now seeing the reinstigation of that right across Europe again, whereby new lockdowns and new restrictions are being put in place. So, does everybody need the money? No, not everybody needs the money that is being provided to them. So what do you do if you don't need the money? Well, you put the money, you save it, and then you're not going to get any interest rates. Okay. I can lend it to higher risk entities like corporate bonds. Yeah, but you probably still won't get any interest rate for it. Okay. What else can I do? Well, of course, I can put it into the stock market. And therefore, this is what I think is really interesting to see, is that as we have seen transfer payments happen really across a variety of full sectors, across full economies, where has that money gone? It is a form, of course, of quantitative easing, only it's not monetary policy, it's fiscal policy, because it's moving from governments into the hands of individuals. So over here then, what I can see here is that retail investors are particularly important shareholders for small and mid-cap companies, and they own an average of 25.1% of companies listed on the stock exchange, London Stock Exchange AIM. This is the alternative investment market. So what we're seeing here is the rise and rise of the representation of the retail investor. So here we go again. We now see the rise and rise of the retail investor. We see the rise and rise of the retail investor, particularly through the millennial. We see the rise and rise of the retail investor through the lens of the millennial, who is also taking greater ESG considerations. And of course, do I have to reiterate the point, is that the millennial and Gen Z investor, the new investor, is far more likely to engage in something like robo-advisor, like Robinhood, like online trading. They are more likely to actually interact with the piece of technology, which loops me right back to the beginning, where I was talking to you about climate fintech, using financial technology in order to work forward with a view on ESG that's happening at the time. Okay, also, what happened here, what we also heard about is the specific businesses. Now this leads me over to the VectorVest system, where I'm going to head here shortly. So what I'm just going to do here is just let me expand this. This is the SDG business case, the $12 trillion opportunity that comes with Sustainable Development Goals, including mobility systems. Now, Tashar, back to you. Back to you again. You're saying solar and wind energy will get in focus. Yes. And who is going to succeed there? But the companies that are focusing on delivering those. Healthcare solutions, particularly telemedicine, that has seen a dramatic rise in 2021. Telemedicine is where, rather than physically go to the doctor, is that instead I might ring up and I might say I have a pain here, or I have a problem here, or I have an infection there, where I don't actually have to travel to the doctor, and they can diagnose over the phone or through chat. But of course, the other thing is right here is the Internet of Things, is when somebody maybe has a sensor on them, like for example, it could be something that is monitoring somebody's heart rate. It could be somebody's monitoring their blood pressure and other things like that. This is healthcare solutions, energy efficiency. In the smarter home, we can now, for example, I have an app now on my phone where I can monitor the heat in the house, and I can actually tailor when the heat is on. So if I say I'm going to be home 7 o'clock, and then I'm actually not home at 7 o'clock, it's going to be 11 o'clock. Instead of the heat coming on automatically at 7 o'clock, I can then tailor it to be on instead maybe at 9:30, so that then it's on for an hour and a half. So the house is nice and warm when I get in, and I can have a bath, I can do whatever. Clean energy, of course, again, really big area, and it's only in recent times it's actually become relatively profitable. Affordable housing, the circular economy, like I told you about sustainable fashion earlier on, healthy lifestyles. Again, back here, like this is a huge industry, a huge, huge industry. Always has been, but is growingly so given the technology that is available for it. Food loss and waste, agricultural solutions, forest ecosystem services, urban infrastructure, and building solutions as well. These are the sectors of the future where we're seeing more and more focus on them. And I also just want to bring you down here sorry, I thought I had another graph there for you. Okay, I don't, so I'm going to stop there on that note. Where I do want to bring you is, this is another key trend that I spotted, including and this is all included in my trend number 4, which is data, is now if I want to invest in an ETF, let's say I'm going to pop on over here to iShares. Okay, going to pop on over here. Here we go. Here's iShares, largest ETF provider in the world, and I am based in America. Here I am based in America, over here, okay. Based in America, and I am interested in, like, for example, one of the key things that they talk about here is sustainable ETFs can be central to how you invest. This is taking more and more of a role, but in particular, let's say I'm not interested in that. You know, I'm not interested in sustainability. I simply want to do my usual. I want to invest in the S&P 500. Simples. I want to keep it simple. Okay, view all funds. Pop on down here, and I would like to invest in the S&P 500. Here we are, rock steady Eddie. This one, which is totally core, totally simple, largest 500 companies in the world, in the US. So far this year, it's up 22%. Lovely. Expense ratio is buttons. Is that for every $100 that I invest in this ETF, it's going to cost me 3 cents in fees, so like nothing. Beautiful returns here over the last 10 years. This would have delivered me 16% compound per annum. And of course, within this, see, that means that I'm going to get this calculator over here to give you the rule of 72. 72 divided by, the return here is 16.58. That tells me 16.58. This tells me how long it'll take me to double my money. It would take me, I would have doubled my money every 4 years based on this. The rule of 72 is divide 72 by the interest rate that you get, and then it'll tell you how long it'll take to double your money, using, of course, the power of compounding. All right, anyway, all this is fine, and I'm looking at everything here that I would always look at, and I would see my key facts, and get a quarterly dividend, and, you know, I mean, look, I can talk about ETFs till the cows come home. The point of the matter is that there's all of this information is here, and I would always look at this, but this is what's different, is now every ETF, independent of whether it's sustainability focused or not, now has the data related to it on the largest ETF provider in the world. When I log in right now, when I log into my own stockbroking account, I can also see what the sustainability characteristics of every stock that I have. I can also see whether each stock that I have, is it exposed to those kind of, you know, sin stocks, whether it's defense or whether it's gambling or whether it might be tobacco. And I can also see whether it's promoting of green energy or whether it has good social and governance. I can see all of that as well. That, I think, is a really big difference in 2021, is we have gone beyond the whole idea that only certain investments have got the due diligence behind it. Now we're seeing that every investment has the data. What is the problem with that? The problem is consistency. And that, I can tell you, is a really big issue. This is why I wanted to make sure that when I was talking to you about this as trend number 4, is that yes, we have a lot more data. And I can bring data up for any ETF. I can bring data up for any stock. I can bring it up for any SPAC. I can bring it up anywhere. The challenge is, how do I know if it agrees? I can look here at, like, for example, what I just showed you there, the MSCI ESG fund rating from, obviously, MSGI. And then separately, I can look at the Fund Lipper Global classification. I can also look at a variety of other sources, and I can get disagreements. And that, I can tell you, was the really big issue that came up during last week's conversation at the conference, is yes, we've got a lot more data, but does it agree with each other? And sorry, let me go on. By the way, this is not just an issue for data providers. It's not just an issue for stocks. It's now gone far beyond even governments. It's gone into supranational governments, because now, particularly in Europe, we are seeing the EU now discuss a taxonomy. And the taxonomy that it's discussing now is, how do we actually define this? And there's 3 levels to this taxonomy. By the way, this is controversial, because how do you get people to agree on this? The way in which the taxonomy is working off is that it is what constitutes a substantial social contribution. If I was to ask all of you, if you could all tell me what you think a substantial social contribution is, and I'm quoting that from the taxonomy development, we might all disagree. I might say, again, let's put me in the, cliche box that you might expect me to be in. I might say, well, it's where women have the same opportunities as men. Somebody else might say, well, a substantial social contribution is where everybody is paid a living working wage and above. Somebody else might say, well, a substantial social contribution is carbon neutrality. And somebody else might say, do you see where I'm going with this? So therefore, is that actually coming up with what actually that a method of agreement in that is actually quite difficult. Number two, the second element of that taxonomy is how to not do significant harm. Not do significant harm. Right, let's take a look at that then. What does not do significant harm actually mean? Well, it could mean that I have to make sure that it does not, for example, invest in certain industries. I might say that it means that to not do significant harm is that it achieves a minimum carbon footprint. I might say that this means that not significant harm is that we have the avoidance of any inquiries around, any racism or discrimination. So what does avoiding significant harm? And then the third thing that it needs to look at is, well, exactly what activities are harmful? Can you really cut it down the middle? And by the way, I am in my fifth trend. I'm going to talk to you about the challenge there is about understanding what activities are harmful. Stick with me on that. So, but what I will say is that is the third part of the taxonomy, is what constitutes a substantial social contribution. So that's the best. If my company can make a substantial social contribution, that's really good. Secondly, is that I would want, in the eyes of the taxonomy, is that second tier is that we would have a company that does not do significant harm. And then the third thing is we need to eliminate companies that eliminate activities that are harmful. But what are they? And do you eliminate a whole company with it? Or how do you challenge that company along the way? Particularly, the two key things that you need along that way is, number one, are clear standards, and number two is to eliminating greenwashing as well. How do you eliminate greenwashing? Where greenwashing or purpose washing is where a company says it's going to do something, but then acts very differently, or has very high environmental standards, but then is appalling S standards. The E is high, the S is bad, and the G is non-existent. Well then, where do we stand when it comes to that? So that's what happens when it comes to the taxonomy. So let me just take you back through each of my trends again. Number one, I believe, is climate fintech. I think that is where we're going to see a huge amount of growth. Number two is the impact of robo-advisor, set and forget. Number three is the rising power of the millennial in the demographic right across the stock market. They're tech focused, we're seeing more of that. They are earning more money, we've seen evidence of that. They're more ESG focused than any other generation. They are going to have a growing impact along the way. Number four is data, but there's challenges around consistency of that data, and also even to get agreement around what data is looking for and what it's seeking to interrogate. Right, now, I'm going to get to my fifth trend now. This one is a little bit more technical. So, what I'm going to do is, before we get to that point, I just would like to hear again from you is what else, or is there any agreements, any disagreements that you have with me thus far? Let me just hear from you, or in particular, what type of companies out there are making the biggest difference when it comes to these things. Let's just hear what else you have to say on this. Just want to hear your thoughts. Anybody agreeing with what I'm saying? Do you agree with me about the data? Are you seeing about the data? Okay. And particularly about the consistency. One of you says, I'm nervous about robo-advisor, can we control it? Now, what I'm going to say here is it okay if I ask the guys back over there in the States, will you pop the link into the chat for the piece that I wrote solely around robo-advisor? I'm going to show you how to find it for everyone, because I can't elaborate hugely on it tonight because we did a whole episode on it. I'll just show you how to find it. If you go to the VectorVest, go to Vector, just in case the guys there in the US might be able to pop a link into the chat as well. So let me just pop on over here to VectorVest, and I am going to go to the blog over here. And in the blogs, you will see all of the pieces that I write in summary. Okay, so let me just pop down here, stock market investing in here. And there we go. Robo-advisor, past and future. You will be in there. You will see all about what I wrote, all about how to look at it. And I spoke about how it's good, and also how it's not, okay? How it's good and also how it's not. And can you control it? Well, it's up to you to decide how you want to control it. It can be done, but ultimately the people who use robo-advisor probably don't necessarily want that. Okay, now let me then get to trend number 5, okay? And this is one that it has been changing and has been growing, but it's complicated. It's complicated, and I think this is the one that is going to require the nuance over the next while. Okay, let's think through this, right? Let's think through this, is that as time is going on and as all of the 4 trends that I have spoken to you about, as people are taking more of a proactive, as they're making proactive decisions about making decisions about ESG and using technology to do that in their daily lives, as they're getting access to more data, as they're automating more of their actions, like as we can see in RoboTrader, right? And as they are making more of a conscious effort because it's becoming more of a conversation now that's happening in various different aspects of our lives. Okay. Then, what do you think the aggregate impact of this is on the cost of capital? My answer to you is not the cost of capital will rise or it will fall, but it will be nuanced. And we're already seeing elements of that. What you're now seeing is that for companies that are not contributing positively to the environment are finding it harder, not harder to raise money, it's just more expensive to do so. And this, by the way, sounds simple, right? This sounds simple. This sounds like, okay, well, oil companies then, they're going to have higher cost of capital. And that means that they will have to give, for example, higher dividends. It means that they're likely to have lower PE ratios. It means that for every dollar of earnings that they're generating is that investors will actually require a higher level of return from them in order to have the risk of the fact that they may be, let's say example, challenging to the environment. Is it as simple as that though? Because if you look at recent stories around this area, I'm just going to pose one particular scenario to you. And thank you very much. Mike says that I'm making great dot connections. Well, that is what somebody like me does, is that I look at all the data and the ideas that's out there and I bring a synopsis to you. But I particularly want to talk to you about this one particular point. Let's take a defense company. Defense equals weapons equals bad, ESG, right? And we are talking about there because of what weapons do. How about if we take the same defense company that is extremely good with cybersecurity? Cybersecurity equals good ESG. So how do you attribute a single cost of capital, which you have to because that's the way the PE ratio works? How do you attribute that to that single company? And that's where I think it's going to be very complicated next year. We have seen the change this year in the cost of capital being attributed to companies differently, is that those that don't have good ESG, either at a very, very macro level or because of something that they've done. We saw that years ago with Volkswagen in Germany. Then we saw investors saying, okay, well, I'm not going to be taking a chance on a company like Volkswagen unless I'm being rewarded through the returns. And of course, the risk there was that since they weren't doing something sustainably, well then, where was that going to leave them? But I think that it's not as simple as that. If you're looking at what a company does, it's not as simple as it does X, therefore that is this, therefore that is that. I think it's going to be more nuanced than that. And that, I believe, is going to be a real challenge. And it doesn't just stop at the stock market. This also leads into the bond market as well. So statistics will tell us that actually green bonds, in comparison to traditional bonds, generally are raising money at 5 basis points cheaper. So that means that if I say I'm raising green money, that in other words, I'm borrowing money with the view to using the money to do something sustainable or to do something for an environmental project, then investors are willing to lend to me at a lower cost. Now, instantly, of course, well then anybody involved in borrowing money should then, of course, instantly be looking at, well, how could I make it greener? Then, of course, that leaves it open to greenwashing and purpose washing, which is, of course, a challenge. But my point is that, and this particularly ties in with the data, is if we are relying on data to tell us whether a company or a government or a project is green or it's focused on ESG, if we are relying on that and that data is inconsistent, then investors are likely to take it into their own hands. Whether that would mean that you're going to have certain companies that are going to be set up, like Sustainalytics, for example, is that something that is likely to happen? I actually, there, another case in point is last week, for the first time, last week, we saw the first listed company in the UK that has the B Corp badge. the B Corp is one that has particularly high ESG standards. That's the point, is that are we going to see investors taking more and more of these considerations into their own hands, and then they're going to be demanding products and services that are doing the investigation for them? That's what I'm wondering. So my point is that as the cost of capital is going to change, well then we are going to see different prices through the PE ratio in stocks, or through the cost of borrowing in bonds. We're going to see changes in that way. And then that means that investors are going to take more focus on what the data is telling them. They're going to see the inconsistencies. We may well see new products and services coming up along the way. But then, as a result, I think investors are going to be attributing different costs of capital to different instruments. That could also mean a really big change, a structural change, in fact. Steve Chappell here at VectorVest always says, money goes where money grows. I agree. After all, earnings, share prices follow earnings. But will we also now be saying money goes where trees grow as well? That's the question. And that I think will be very, very interesting to look at in the year 2022. Okay, so they are my 5 trends. And just to take you through this again, number 1 was climate fintech. Number 2 was a rise of robo-advisor. Number 3 was the demographic changes that we are seeing. Number 4 is the amount of data and its inconsistency. And number 5 is the changing cost of capital that is being made available through all of the other trends combining. Now, before we finish up here, I do want to finish on this, is that I do think it is also important to look at the year that has happened and what would you do when you're investing today. So let us pop on over here to the VectorVest program. And over here we can see that the MTI, okay, if we take a look over here, let's take a look over here, and let's take a look over here. Let me just toggle this. And I just want to take a look at the MTI over a different period of time. I want to look at this over end of day for a year. Okay, this has been the market timing indicator in America. Over the past year, we have seen that, like, by the way, this looks like it's falling. It's not. This is not the index. The index we know has delivered 22% based on what we've seen at the S&P so far. What I am talking about here is the momentum that has been in the market, and that if I take a look at this level here, this is above 1. Most of the time this year, the market was very bullish. And the vast majority of the time this year. But I do want to point out what's going on at the moment, because it's important, is that here we are at the end of the year now. Let's think through what happens at the end of the year. Think about all the non-retail investors. Institutional investors, of course, have year ends. Of course, then they also have to mark up the return on investment. And just an insight into asymmetric risk that I want to give you here is that typically institutional investors, if they are running, for example, hedge funds, there is the 2 and 20 rule. That means that they get 2% of their money, or 2% of the AUM, the assets under management, they get, and 20% of any outperformance over the index. Index did very well this year. It is pretty hard to top 22% unless you did other things. Okay, where are we though? Here we are, 6th of December 2021. 6th of December 2021. If I don't achieve an outperformance at this stage, will I lose my bonus? Yes, because of course there won't be any outperformance. But if I don't outperform, will I be taxed, or will my bonus, will it be delved into? In other words, will I lose out on money if I underperform? Typically not. That's the way the 2 and 20 rule works. So therefore, what you can often see is outsized risks being taken by those parties who've got asymmetric risk built into their bonus in the first place. So first thing I want to say is, remember, a lot of people have a year end and can withdraw money before we get to that point. Number 2, you can have asymmetric risk being taken because of the 2 and 20 rule. And number 3, of course, is tax loss harvesting. For example, here in Ireland, if I make a gain in any given year, the government will allow me to make 1,270 euros tax free. Okay? If I do not close out some positions, if I don't do that, and let's say I've had a phenomenal year, which thankfully it's been a very good year, phenomenal year, and I don't close out my positions, well then I can take that 1,270. I cannot then use up my tax-free allowance, or I cannot offset any loss against the gains. So be watchful of all of those things that are happening around about now. Okay, what have we seen? Well, in the last couple of weeks, and I'm going here for the 8th of November Today is the 6th of December, of course, this is live. During that period of time, we have seen a really significant fall in the market sentiment, particularly in the market sentiment. So you can see here, in the case of VectorVest, we have got a confirmed down call. And a confirmed down call was issued on the 22nd of November. Over here, on the 22nd of November. Since then, we have seen a series of red lights. Red lights is when the market is down day over day and week over week. Down day over day and week over week. Yellow lights is when you see the trend reversing or weakening. Now, you'll see one before the other. When this turns to green again, you will see yellow first, which kind of says, okay, actually, okay, maybe the sellers are exhausted here. Maybe it's time for the buyers to get back in the game and to push it back up again. So that would be when you see the sellers slowing down. When the buyers are pushing the prices back up again, that is, of course, a reversal of the trend that we're seeing at the moment. So you'll see yellow before you see green. When you see green again, you'll see green over here first, and you'll see green lights, which is when on a day-to-day basis, on an intraday basis, this is when buyers are pushing up prices relative to sellers again. Now, at the moment, we don't see any evidence of that. Like, I don't see any evidence of that. When I look here at the MTI, now I know I appreciate that it's particularly hard to see on a screen, particularly if you look at a mobile device. I can see there that the MTI fell below 1 the day after the confirmed down call was issued, and then after that it has continued to fall. Now it has kind of stabilized, as we can see, with lots of yellow lights, but at the moment I'm not seeing the green light get back and into the market. What I would watch out for is, number one, the green light over here. Number two, when you see the MTI turning around, particularly breaking over 1, and then of course also when you see the primary wave turning up. The primary wave right now, the primary wave is the direction of travel of the market over 5 days. The primary wave is not rising. It's continuously on a down curve here at the moment, including today so far. So that, when you see that turning, that's another bullish sign. And then the last one, the most conservative one that you get, is of course the confirmed up call. So right now, as all my market timing indicators here are telling me, okay, Susan, take a chill pill here and relax here a little bit. Don't be getting into the market anytime soon. If I didn't understand a word of that, you can see it right here, and that is on the colour guard. And the colour guard right now is simply saying the colour guard is neutral. VectorVest does not advocate buying any stocks at this time. But what I wanted to do, and to leave you not just at the end of this show, but at the end of this month and at the end of this year, is to point out how to look out for the green shoots. Did you get it? Green shoots? ESG? Okay, I'm sure you do. And in looking at that element, that is how to keep an eye on the market. We can see here the S&P 500 is up today 1.52%. We can see the Nasdaq is up. We can see the Dow is up. We can see the VectorVest composite is up. But all told, as they say in Ireland, one swallow does not make a summer. What you need to do is watch out for those trends. And the more conservative you are, or the more reassurance that you need, there I've given you particularly what you need to look out for. So the red lights moving to green, the primary wave moving up, the MTI moving above 1, and the last one is that you're likely to see is a confirmed call moving up as well. Then is a good opportunity for you to revisit your ideas. Okay, well, on that note, I am now going to bring this episode to a close. Thank you all indeed so much to everybody who chose to be here, not just today, but right throughout the year. It really was my pleasure to lead the ESG and Tech Show for you. We have loads of ideas, and I mean loads of ideas. My full plan is ready to rock for 2022. I am going to be delighted to see you in January, and when we're going to talk about an awful lot more themes. But between now and then, I wish you the best of festive seasons that you've ever had yet, and absolutely great prosperity to you in 2022, and I'm going to see you then. Thank you and goodbye.